Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one of the so-called passive funds that sits within our new list of 72 favourite funds, namely iShares Core MSCI Pacific exJapan ETF. Now, I know that's a bit of a mouthful. This is an exchange-traded fund, or ETF. It's designed to track the performance of the underlying assets and then deliver that performance minus its running costs. In this case, the ETF is tracking an index that features around 150 large and mid-sized companies from 4 of Asia's 5 biggest markets, namely Australia, Hong Kong, Singapore and New Zealand. The nation that's excluded, as the instrument's name rather suggests, is Japan. Note that China isn't yet included in the MSCI indices, by the way. iShares Core MSCI Pacific exJapan uses physical or direct replication to generate performance, so it owns the underlying securities. The top 5 holdings as I sit here are Commonwealth Bank of Australia, Westpac Banking, Hong Kong-based insurer AIA, ANZ Banking and National Australia Bank. Mining giant BHP Billiton is 6th on the list, by the way, via its quotation in Sydney. By country, Australia is just under 60% of the assets, Hong Kong around 28%, Singapore is 10%, and New Zealand the rest. By sector, as you've probably guessed by now, financials dominate at 40% of the assets, with real estate next up at around 15%, followed by industrials and mining at 8 to 10% each. Tech, energy, telecoms are only lightly represented and only just cover around 7% of the portfolio. The tracker comes with an ongoing charge figure of just 0.2% a year, so it's very cost effective. According to data from Morningstar, it's actually the cheapest ETF in its category. The iShares product has around £760 million in assets under administration, so it should be pretty liquid, at least under normal market conditions. This particular instrument comes with accumulation units, so any investor buying will have any dividend payments automatically reinvested for them. The tracker is over 7 years old and comes with a 3-star ranking from Morningstar for those who place importance on such things. So, those are the mechanics. The next question to address is, why would an investor potentially consider this ETF for their portfolio now? And I think there are 3 factors to consider. First, if you buy into the global reflation or Trumpflation trade, whatever you want to call it, in the view that global growth and inflation are about to accelerate, then banks, financials and real estate plays are sectors that generally do well in such an environment, at least if history is any guide. As we can see here, the ETF has also done well over the past year. Second, Singapore is also seen as a good play on global trade and global growth, with banks, real estate and industrials over half of the local Straits Times Index's market cap. And finally, Australia is heavy on mining and resources as well as banks, and is therefore seen as a way to access the China growth theme. With the 19th Communist Party Congress taking place this autumn, it seems likely the Chinese authorities will do what it takes to make sure that China hits its 6 to 7% GDP growth target for this year. That could boost raw materials demand. Now, none of this is to say the ETF would necessarily sue every investor, as there are at least 2 clear risks. First, some analysts are expressing concerns that the Aussie housing market is getting terribly overheated. Now, that may not make it any different from the UK, Canada or Sweden, for example, but a downturn could hit the Aussie banks, which feature prominently in this ETF's top 10 holdings list. Second, having primed its economy with fiscal and monetary stimulus in 2016, China is now tightening policy, so its own property and stock markets and economy don't boil over. That's currently hitting metals and raw materials prices, and mining stocks are actually sliding in sympathy. Any big slowdown in China would be potentially a big problem for the underlying stocks tracked by, say, the upper echelons of this particular ETF. In summary, please do your research before you put any capital at risk, and only you can judge whether you think iShares Core MSCI Pacific exJapan ETF ultimately fits with your overall strategy, target returns, time horizon and appetite for risk. Thank you for watching, and I look forward to seeing you next time.